Indebted consumers are in for a difficult time this festive season. Their disposable income will be further reduced as they will be paying more for their debt. Reserve Bank Governor Lesetja Kganyago says risks to the inflation continue to be on the upside going forward. This is on the back of continued Russia-Ukraine war affecting prices globally, high oil and electricity prices. Inflation is expected to average 6.7% for this year, higher than the Reserve Bank's targeted 3 to 6%, before slowing to 5.4% next year.
The response of the MPC with this policy decision is to respond to the future pressures that could build up with inflation. And this is necessary because South Africans are complaining about the rising cost of living, and it is important that the central bank continues to deploy its instruments to tame the monster of inflation.
The 75 basis points increase means all forms of debt that consumers hold will go up. If you are repaying a car loan, or you have a credit card or a home loan, repayments will increase by 75 basis points. If you are repaying a home loan of R1 million over a 20-year period at prime lending rate, on average, your payments will go up by R499. Your bond installment would have increased by R2,080 when you look back at what your repayment was in November last year, when the Reserve Bank started hiking rates.
Having seen the interest rate now above pre-pandemic levels does suggest that debt servicing costs for indebted consumers has risen. And that means that there's more money that's being allocated to servicing debt and taken away from other spending on items in the economy. As a result, we do believe that the consumer is in a weakened position. And going into next year, we believe that a number of headwinds are mounting for the South African consumer, including a reasonably bleak employment outlook on the back of the growth forecasts that have been penciled in from the South African Reserve Bank.
The high interest rate environment will likely impact sectors in the economy like retail, as consumers will have limited funds to spend.
It has a negative impact on the retail sector. So, with increased debt servicing costs, obviously consumers have less disposable income to spend on more discretionary goods. So that sucks a lot of capital and spending out of the retail sector. And of course, with higher interest rates, your growth, GDP growth, gets affected with a sort of a 6 to 9 month lag. So that for many sectors in the economy, that's a headwind.
The Reserve Bank has downwardly revised expected economic growth for this year to 1.8%, down from 1.9% at the last MPC meeting. Economic growth is expected to slow to 1.1% next year. Gloria Sefako Musi, SABC News, Johannesburg.